Welcome back to Trading Club Q7U, I'm your lead educator. Today, we're going to dive deeper into the world of portfolio risk and correlation, two critical concepts that every trader needs to understand. You see, managing risk is not just about avoiding losses, it's also about understanding how different assets move together. Think of it like driving a car through a busy city. You need to be aware of your surroundings, the traffic, and the road conditions to avoid accidents. Portfolio risk refers to the potential loss of value in your investment portfolio. It's the risk of losing your shirt in a poker game, where the more you bet, the more you risk losing. When you trade, you're essentially betting on the price of an asset moving in your favor. If the trade doesn't go your way, you can lose some, or even all of your money. Let's take a look at an example. Suppose you have 3 trades in your portfolio, 2 in stocks, and 1 in a commodity like crude oil. The first stock is a long-term hold, while the second stock is a short-term trade, and the commodity is a medium-term trade. If the commodity trade loses 10, that's a 300 loss, assuming a 3,000 investment. However, if the 2 stock trades both lose 10, you'll lose a total of 2,500. The key here is that the commodity trade was only 3,000, while the 2 stock trades were 2,000 and 500, respectively. This is a classic example of how correlation can affect portfolio risk. Now, let's talk about correlation. Correlation is a measure of how much 2 or more assets move together. Think of it like 2 friends who like to go on vacations together. If one friend likes to stay at a hotel on the beach, and the other friend likes to stay at a hotel in the mountains, they're not correlated. Their vacation preferences don't affect each other. However, if both friends like to stay at a hotel in New York City, they're strongly correlated. Their vacation preferences are likely to be very similar. In trading, correlation is essential because it can affect the risk of your portfolio. If you have 2 trades that are strongly correlated, they can both move in the same direction or in the same losing direction. For example, let's say you have 2 trades, one in a stock called XYZ, and another in a commodity like crude oil. If the 2 trades are highly correlated, they might both move up or down together. But if they are not correlated, you might see one trade move up while the other trade moves down. The main mistake beginners make when it comes to correlation is assuming that all assets are uncorrelated. The truth is, many assets are correlated to some degree, even if it's just slightly. This can be good news or bad news, depending on your strategy. To avoid this mistake, you should do your homework and research the correlation between different assets. You can use tools like correlation charts or statistical analysis to help you understand how different assets move together. For instance, if you're trading forex pairs, you should research the correlation between different currency pairs, such as USD and USD. Another common mistake beginners make is not diversifying their portfolio. Diversification is key to managing portfolio risk, as it can help reduce your exposure to correlated assets. For example, if you have 2 trades that are highly correlated, and you want to reduce your risk, you can add a third trade that's uncorrelated to the other 2. Now, let's talk about some specific correlation examples. Suppose you're trading oil stocks, such as ExxonMobil and Chevron. While these stocks are both involved in the oil industry, they are not perfectly correlated, as they are listed on different exchanges and are subject to different market forces. However, they are still correlated to some degree, as the price of oil can affect both stocks. Similarly, if you're trading tech stocks, such as Apple and Amazon, these stocks are highly correlated, as they are both part of the same industry and are influenced by similar market trends. Now, for your homework exercise, I want you to open a demo chart and trade 2 assets that you think are uncorrelated, like a stock and a commodity. Record the prices of the 2 assets and see how they move together over the next trading session. Pay attention to how much they are correlated, and think about how you can use this information in your trading strategy. For example, you could trade Apple stock and crude oil. If these two assets move together strongly, you might want to reconsider your strategy and look for more uncorrelated trades. On the other hand, if they move together weakly, you might see an opportunity to diversify your portfolio and reduce your risk. In conclusion, portfolio risk and correlation are essential concepts to understand when trading. By managing your risk and being aware of correlation, you can reduce your losses and increase your chances of success. Make sure